Yes, I've made the famous sin of being on mute. Apologies. Good afternoon, everyone. Welcome to our Accounts for Non-Accountants. I'm Saatchi Blakemore. I'm a partner in the charity and not-for-profit team, and I'll be starting with the first session, which is statutory reporting for charities. And then I'll hand over to my colleague Jamal, director in our team, and he'll be going through the Trustees Report. And then the final session for this afternoon will be the more sort of judgmental areas that charities need to consider when looking at their finances, and that will be led by Catherine Biscoe. Catherine's a partner in the team as well. And in terms of just some housekeeping, if I can ask you to put your mics on mute until the end of the session, which will be approximately 60 minutes. The aim is that if you have any questions during the session, please feel free to put them in the chat. Only we can see the questions posted. We'll aim to answer as many as we can at the end of the session. And if for any reason we can't get to your question, we do promise to respond to them through email. And we'll also be sending our slides to you. Okay, so starting with the first topic, which is statutory accounts for charities. So the purpose really in the next 20 minutes is really to give you an overview of some of the key requirements. Charity accounts are presented in a particular way with specific headings. There's a purpose behind that, and it's understanding that purpose so that you can actually, when you're looking at your own charity's accounts, understand some of the key financial relationships and actually ask some sensible and challenging questions when looking at your charity's figures. So beginning with, where do the requirements actually come from? Your charity's accounts will be prepared under charities SORP, the Statement of Recommended Practice. It's issued by the Charity Commission. And what it is essentially, it's a set of rules and guidance for charities to follow based on legislation in the UK, and that includes accounting legislation, but general legislation as well, such as Companies Act, FRS 102 reporting, and so on. Next slide, please. So I think just one point of clarification, which I'll go into before I go into the detail of charity accounts. The Statement of Recommended Practice, the word recommended is a misnomer. Ultimately, if you want to show your charity's accounts to show a true and fair view, very few charities have the option of not following the SORP. In fact, it's only very small charities that can prepare some very simplified accounts, but generally speaking, most charities will have to follow the SORP. And the sort of basic guidance around this is that it's only if you're a company charity, an incorporated charity, you have to follow the SORP. But if you're unincorporated and only if your income is below 250, are you basically exempt from that requirement? Next slide, please. In terms of other sort of compliance thresholds, requirements, etc., two key things. One is, do you need an audit or not? And the basic figure to really take into account is if your charity's turnover is more than £1 million, you will need to. It's a statutory reason to have an audit, so you're not exempt. And the second point I wanted to make is that if you are a charity that has income of below £1 million, you have an option of doing what's called an independent examination, and some of you may well be familiar with that in terms of your charity. An independent examination is far less onerous than an audit, and therefore it takes far less time and cost. But before you opt for that particular examination, I think it's worth considering sort of wider commercial consideration. A lot of funders, for example, want to see monies they give to other charities, their accounts are audited. So it's a key consideration to discuss by trustees and management if you're thinking about it. Next slide, please. So what does a set of charity statutory accounts look like? Very simply, most charity accounts that you will pick up will follow the order that you see in front of you on the screen. Reference and administration, as it says, it's very much that, your address, names of directors, senior management, and so on. Trustees annual report, Jamal will cover the detail of that shortly. Then you'll have the auditor's report or the independent examiner's report, and essentially you're looking out for the opinion. Does it concur that your accounts show a true and fair view? And then the next two, which is the statement of financial activities, which is your profit and loss account or income and expenditure for the year, and the balance sheet, which is the funds you hold ultimately at the end of the year. Those are the two items that I'll focus on over the next few slides. But for some charities, and it's really charities that have income of more than £500,000, you'll also see what's called a cash flow statement. And what a cash flow statement ultimately does is it sort of shows your charity's activities on a cash basis from the start of the financial year to the end of the year. So it effectively allows you to see that sort of where has the cash been spent in the organisation during the year. You'll then have usually 2 or 3 pages of accounting policies, which sets out how certain items have been treated in the accounts. And then you have the more detail. So if you're particularly interested in some of the key figures in the balance sheet or the statement of financial activities, you then go to the notes to the accounts. Next slide, please. Okay, so the statement of financial activities, and I'll call it SOFA for short, is essentially a summary statement of your income and expenditure. And if you're a charity and you have other entities within the group, you have a trading subsidiary, you may have 1 or 2 other charities, etc. A charity is required to show that income and expenditure on a group basis. And if you wanted to show only your charity's income, that's an extra, that's an optional extra. But really, most charities will stick to the requirement, which is showing the figures on a group basis. Next slide, please. Okay, so this particular slide is not a set of, it's not a SOFA for a charity. It's actually a very simple profit and loss account for a company. And I've put this on the screen to illustrate the point that if you're familiar with company accounts, usually it's relatively easy to be able to read the profit and loss account for a company because it only has 3 or 4 key rows. One is income, the other is costs, and you can pretty much then get to the bottom and work out the surplus or the deficit for that year. If you go to the next slide, this is an example of a charity's SOFA, the income and expenditure account. And all of a sudden, even without looking at any of the detail, you'll see that there's lots of headings, there's a lot more rows, a lot more columns, and there's a lot more information to absorb, which makes it very difficult to understand the overall position, potentially. So if I can help you with that piece and start with looking at the different columns of information for each charity and why it's presented. So if you look at a charity's SOFA, typically the first column that you will see in the charity's SOFA will be headed up as unrestricted funds. And unrestricted funds are typically monies that a charity will receive that has no restrictions to it. The charity, its trustees, management can spend the funds as it sees fit, and therefore they're unrestricted. Occasionally you'll see, usually in the balance sheet, but sometimes on the SOFA, another column that says designated. And designated is a subset of unrestricted funds. It's what the trustees have decided. They're going to earmark a set of funds for a particular project in the future, an area they want to spend in, and therefore it's treated as designated, but ultimately it's still unrestricted funds. The other column you'll see is restricted funds. Restricted funds, charities are fairly unique in terms of the types of monies it receives, and one of the sort of uniqueness of a charity in that sense is restrictions on funds from donors. Donors will often give money for specific appeals or will restrict areas they want funds spent on, and charities have to show that separately. And the question that we're often asked as auditors is that if I don't spend the money on that particular purpose, can I use it for something else? And the straightforward answer is no. It's a legal requirement that you need to meet. If your funder's given it for a specific purpose, if you spend it on something else, it's ultra vires. And charities who are left in a situation they have accumulated unspent restricted funds, they can either contact the donor and get the permission to release them, or the other alternative, and it's occasionally used by charities, is to speak to the Charity Commission, and you'd have to get the Charity Commission permission. And then the third column that you have is endowment funds. So endowment funds are really where there are time constraints on when the monies can be spent. And typically you'll see endowments with grant-making charities. They're not as common with other organisations, but you may well have that for your charity also. And there are two types of endowments. One is permanent. That means someone gives you the funds. You can't actually spend the capital monies that they've given to you, but you can invest the money, and any sort of return you get on that investment, for example, investment income, you can use for unrestricted purposes. And the other type, which is even more uncommon, or it's rarer, I should say, is expendable endowments, where you have a time period. So you're given the money, for example, those first 5 years, you can't touch it. But after 5 years, you can spend it on X, Y, and Z. And so you have that distinction between permanent and expendable endowments. So these are the key columns, but it's really important to understand also the rows of information that you see in the SOFA. When you start off on the SOFA, if you're looking at the income side, the left-hand side of this slide, the first row you have is donations and legacies, and that's exactly what you include in that particular categorisation. And it includes things like general grants. If you get specific monies for restricted projects, etc., grants, etc., they will go under charitable activities. After donations and legacies, you've got other trading activities, and as the name trading suggests, it's really activities you undertake in order to raise funds. So if you have a trading subsidiary, for example, and the trading subsidiary will often include things that you put aside for tax reasons like sponsorship income, all of that goes under other trading activities. And then you have underneath trading activities investment income. So this is income from your listed investments. You'll hopefully get some interest on your bank account if it's significantly large. If you've got investment properties that you rent out, all of that income is classified within investment income. And then you get to the middle section of the slide, and you've got charitable activities. And these activities are the core reason why your organisation exists. They're the primary reason for the organisation, the purpose of what it does, and therefore the monies you received are directly related to that. So if you're, let's say, an independent school or a membership organisation, you'll receive fees for the services you provide, and that would go under charitable activities. If you undertake a lot of projects, research, you get grants specifically for those, they will be examined under charitable activities. And then you have what I call other, the sort of the balancing column. It's income that doesn't easily fall into any of those other categories. And if you see that in your charity's accounts and the number is quite large, it would be one thing I'd want to understand. Hopefully go to the note that gives you a further description of what that other income is, or it's something you inquire management of to find out what it is. You'll also see, as you go to the right of the slide, the categories for expenditure. Now, when you look at your charity's SOFA, the information is income at the top, and then you've got the expenditure categories. I've presented it in this format to actually demonstrate to you that the income categories and the expenditure categories, they mirror. And if you want to understand the financial relationship between the two, you can easily go across to the expenditure side of the activity you're looking at. And this is particularly important for both for charitable activities, but also activities that involve fundraising. And if I can maybe demonstrate that point on the next slide. So on this slide, you've got all categories that are fundraising related. They're not related to the primary purpose of why you exist. All of these activities you undertake, you're trying to raise funds. Now, this particular area, you'll obviously have costs relating to that fundraising. Now, if your costs consistently exceed the income you're getting, then you ought to be, as a trustee, as a member of senior management, be asking the question, should we be undertaking these activities? Now, it sounds very simple when I say this, because typically with any fundraising activity in particular, there's a bit of a time period. So in year one, you invest in setting up a fundraising department. It usually takes a little bit of time before the money starts coming in. So when you're looking at this relationship between income and expenditure, really important that you think about a longer time horizon. And if you're seeing this consistently year on year, that costs exceed income, you really need to understand why. On the charitable activities side, which is on the next slide, you'd be interested in understanding the financial relationship of how much money you get for your charitable activities and where you spend it, but the focus of understanding that relationship is slightly different. So really, if you're looking at the costs that your charities incurred, you really want to understand the makeup of those costs. And you will find a note, usually in the expenditure notes, that shows how your charitable expenses have been spent. And this will include the direct cost of the charities activity. So if you're a school, it will staff costs, buying educational materials, etc. Then there will be support costs, which are the indirect costs. So it will be the cost of employing people in the accounting team, the finance team, HR, marketing. You can't attribute it to one activity, but it's across several areas. And then you will also give funds to other charitable organisations, individuals, to help them out, help with their charitable purpose, and you'll make grants, and you show that as a third categorisation. And again, there is sometimes a little bit of sensitivity around support costs. Rightly or wrongly, there's sometimes public perception that charities should have certain parameters around support costs, because if all your money is being spent on support costs, are you making the right impact by spending possibly less on the direct costs? It's not. There's a lot more complex and commercial thinking around it. But I think it's the point I'm trying to emphasise. It's really important to engage with understanding how much is being spent where, and then being able to ask the right questions. On to the next slide, which is how do you recognise costs and income in a charity? It's possibly not as straightforward as it is for companies. Companies, there's a principle that you match your income with costs, and therefore, there's a sort of a balancing effect, so to speak. There is an element of that definitely in charity accounting, but it's a bit more nuanced. And I think two key things to take into account. With expenditure in charities, you recognise it when there's a legal or a constructive obligation. So you employ staff, there's a legal obligation, you recognise staff costs at the end of each month in your accounts. The second one is probable, which is there more than 51% chance of me having to pay for it? And if not, you possibly don't recognise it. And can I put a number to it? Is it measurable? And you have to be able to tick off each and every one of those three criteria before you put a liability in the accounts. And a good example where this might be a bit more uncertain is something like a legal claim, where you don't know if you're going to have to settle, you might not know how much, and potentially it might be something that you don't include in the accounts. But it's certainly a sort of a judgment consideration for the charity. On the expenditure income side, there's similar rules around 3 rules, have to meet all 3. Can I measure it? Am I entitled to it? Has it been given to the charity? And how probable is it? Is there more than 51% chance of getting it? And if you, for example, get a conditional grant or an unconditional grant, again, you only become entitled to it when you've met the conditions for that grant to be recognised. Moving on to the balance sheet on the next slide. The balance sheet is really your assets at the year end. Tangible fixed assets are things like your computer equipment, your office building, etc. Things that you use for more than a year. So that is relatively straightforward. Then you have investments. Investments are listed investments. And the key thing about investments is that charities do need to include it at market value, and that includes investment properties. So there's an element of getting that information available for the year end that needs to be taken into consideration. And then you have what I call working capital. Working capital is things like you got cash at bank, you'll have debtors. So these are monies that you haven't received but are due to the organisation. And you'll have creditors. Creditors will include, again, payments that you have to make, but you haven't made the payment yet. Things like rates, electricity, etc. you accrue for. Your charity will have, on the next slide, sorry, getting ahead of myself, you'll have creditors more than 1 year, which typically tends to include things like bank loans. But if for example, you're giving money to other charities, such as grants, they might be over a period of time. So there's a liability that exceeds beyond 1 year. And then the last thing I'll say on the balance sheet before I hand over to Jamal is, for some charities, but not all, there will be a pension scheme liability for defined benefit pension schemes. They are fairly complex. There's a distinction between some pension scheme liabilities that don't go onto the balance sheet, like teachers' pension, and then local government pension schemes, on the other hand, you do need to include it if it's possible to get a valuation that's relevant to your organisation. The valuation themselves come from the actuaries at the end of each year. There are certain key assumptions around inflation, which is obviously a hot topic at the moment, but pay increases, etc. And I think that's something, if you have a pension scheme liability, is just to be aware of what that liability is and what some of the assumptions being used are. I think at this point, I will hand over to Jamal to do the Trustees Report.
Thanks, Archie. So for the next 20 minutes or so, I'm going to be going through the main narrative report, which accompanies the annual accounts, and that's the Trustees Report. So if I begin on my first slide by just setting out why the Trustees Report is needed and why it's so important. Fundamentally, its purpose is to ensure that the charity and its trustees are kept accountable for the stewardship of the charity and also for the management of its funds. The Charity Commission has been increasingly more active in reviewing trusts accounts and governance-related matters for registered charities, and that's partly because of some really quite high-profile cases where charities have failed to do what they were meant to be doing. It's often said that there's no such thing as a private charity, and we'll come on to some of the key stakeholders of your organisation shortly. But what all stakeholders ultimately expect trustees to be able to provide is a clear account of how their organisation has been governed and how they've used the income that the charity has earned. And the Trustees Report is a key means by which that account is provided. There's also a requirement for all charities to explain how they have provided a public benefit through their activities. And again, the Trustees Report is a mechanism through which that legal obligation can be discharged. Beyond the core purpose, the Trustees Report is also used by many charities as a marketing tool, particularly for trusts that are fundraising and also for organisations that are trying to advocate for change. It provides the opportunity for your charity to really showcase the impact it's had for its beneficiaries, and it also provides an opportunity for you to raise awareness of the issue or the issues that your charity is trying to solve, and also the key challenges that your trust requires your help with. Also, just following on from Sachi's section of the presentation, as we saw, charity accounts can be quite complicated or difficult to make sense of, and that's even more so where there's no proper context or commentary over the figures that are being presented. A good Trustees Report will be able to provide that narrative to help the reader of the accounts make sense of the numbers. The final point to note here is that a well thought out Trustees Report can actually help attract more funding and more talent for your organisation. So much so that some charities will get their marketing or communication teams involved in the drafting of the report, or even buy in the services of an external design and print company to help get the messaging just right. So on the next slide, we've tried to give a roundup of who may be interested in reading your Trustees Report. It's really important to acknowledge that there are multiple stakeholders for any charity, and all of these parties are going to hold an interest in what's been reported by the trustees. It may be that the areas of focus for each stakeholder is different, and as you're drafting the trustees report, it's worth just periodically reminding yourself of who your audience includes and how the different groups may read into what's being said or what they may take away from your report. Obviously, the regulators are very much keen to see your accounts. And as I mentioned previously, there's been a lot more scrutiny in this area that we're seeing from the Charity Commission in relation to the annual report and accounts. One of the 5 strategic objectives included in the Charity Commission's 2018 to 2023 strategy is labelled holding charities to account. And we can see evidence of this in practice with the Commission following up on submissions of accounts that are clearly non-compliant. Your supporters are, of course, interested in how their support has helped the charity deliver its strategic objectives. And this may be those who have made a financial contribution to the organisation, but also those that may have helped in other ways, such as by volunteering their time. This group will, of course, also include the future supporters of your trust. These individuals may be trying to decide between different charities supporting similar causes, or they may just want assurances that your organisation is well run and that their money is going to be used appropriately. Other charities are also going to be looking at your report and accounts, particularly competing charities, those that are serving the same group of beneficiaries. They're going to be interested in what your trust has been doing, including, for example, how you've approached fundraising, the sort of successes you've had, and the impact of your work. But they may also just be looking for opportunities where they may be able to collaborate with your charity on specific projects. Your beneficiaries are, of course, trying to get better context over whether your charity can help them. We'll come on to the power of real-life case studies a little bit later in the presentation, but the inclusion of such examples is something that can really help your beneficiaries understand what it is that your charity does and something that they can take real encouragement from. We mentioned volunteers previously, but also your employees may be interested in the report. It's really nice for your employees to be able to take a step back at the end of the year and see the impact of their support more holistically. Many trustees report includes a section within the report to publicly thank their supporters, including employees and volunteers. We've also noted journalists on the slide. There's aspects of the annual report and accounts that do get more attention from the media, particularly around staff salaries, how they're determined, what the CEO is being paid. National charities tend to be under the spotlight a little bit more than, say, a smaller charity, but still really important to consider the potential for journalistic scrutiny of your annual report and accounts. And of course, HMRC also holds an interest in the accounts, particularly given some of the tax advantages that come from holding charitable status. As I say, in all of this, the key is working out what your core messages are for the different stakeholders and working out the best way of getting that message across. So if we move on to the next slide, what does the Charity Commission actually require your trustees report to include? The requirements for the contents of the trustees report are covered within just 10 of the 216 pages of the charity SORP, and the mandatory items in terms of the content fall within the major headings that are noted on the slide in front of you. The ordering of the individual areas is flexible. Having said that, it's unlikely that all stakeholders are going to be reading your annual report and accounts from start to finish, cover to cover. So what most charities tend to do is focus on getting the more important messaging around the charity's work and its impact delivered early on within the document, saving some of the more administrative and governance-related commentary for the end of the report. Some charities also voluntarily include an executive summary, typically in the form of a chair's report or a chief executive's report, or maybe both. This would come right at the start of the document to help get those key messages delivered in a concise way right from the outset. In terms of the length of the document, again, it's important to get the balance right. In a larger charity which undertakes a lot of different projects and has a lot of success stories to tell, it can be tempting to report on every single achievement for the year. That's great, but what that can mean is an extremely lengthy trustees report, and in turn less engagement with the document overall from the reader. If it's pure narrative reporting that's being included, you probably want no more than 20 pages of A4. But of course, one of the things that we'll see a little bit later in the presentation is the power of infographics, photos, charts, case studies, and quotes. These can really help bring your charity's work to life and make the content a lot more digestible and engaging for the reader. So if we take each of these mandatory areas in turn, I think given that our time is limited, I'll skip over a couple of the more straightforward bits and spend a bit more time on the more interesting bits where it may be worth just giving a bit more thought when it comes to drafting your own annual report. So moving on to this slide, on objectives and activities. This is perhaps one of the most important sections of your annual report, as it's basically explaining to the reader why your charity even legally exists and the change it intends to make through its existence. It's an opportunity for you to share your overall vision, mission, your values as a charity, your strategic aims and objectives. And it's also an opportunity for you to explain the work that you've planned to help achieve those objectives. Sashi spoke earlier about analysing your charitable activities into distinct headings within the statement of financial activities, and you'd probably expect to see some degree of consistency between what you're saying in this section of the trustees report and then how you go on to present the figures within the financial statements. The bit that often gets missed from this section is an indication of the criteria or measures that you intend to use to assess the level of success against your objectives. I guess these can be seen as similar to key performance indicators for corporate organisations, but it's good to note what those metrics are right from the outset if it's not already implied from the objectives that you've recorded. This section is also sometimes used to refer to key policies. The specific policies referred to will be dependent on the activities of your charity. So, for example, if you're a grant-making trust, you should be noting your approach to reviewing and awarding grants here. Something we're seeing more and more charities comment on is within their annual report, is their approach to diversity and inclusion, and also their approach to ESG or environmental, social and governance related considerations. These areas are important for any charity, but I guess if your trust is focused, for example, on social inclusion or environmental sustainability, then of course commenting on these areas should not be overlooked. On the next slide, we've provided extracts taken from the first few pages of the accounts of the Trussell Trust. You can see here how they've tried to make it really clear in terms of what their vision is, what their values are as a charity, and the key activities that they've been undertaking in a really concise way. I appreciate that some of the text may be a bit difficult to read here, but we will be sharing the slide decks with you after the presentation, so you can take a look at some of the examples that we've included in a bit more detail at your convenience. On the next slide, we move on from what you've said you wish to achieve to reporting on your actual achievements and performance. Again, a really important section of your trustees report, and this is where you can get really creative in terms of how you tell your story for the year. One of the things that the SORP makes clear is that the trustees report should be a fair and balanced account of what's happened in the year. And that means not just reporting on the successes, but also commenting on anything that didn't quite go to plan. So, for example, it may be that more funding is needed to get a really important project delivered, and by highlighting the challenges you've had within your trustees report, you may be able to garner additional support to be able to help complete the project in the coming year. Again, it's worth thinking about your audience in order to determine the best medium to showcase your achievements. For example, charities that work with individuals trying to turn their lives around following personal challenges often find that case studies are a really powerful tool. Charities that are undertaking charitable work in developing countries, on the other hand, may find it really useful to include photos of the work they're doing overseas. And charities that are delivering on contracts or volume work may want to be more numbers focused in their reporting. If we head on over to the next slide, we can see a few examples of these storytelling tools in action. So on the left-hand side of the slide, we have a case study and quotes from a beneficiary of the Cardinal Hume Centre, with Motion commenting firsthand on how the charity has helped change his life. On the top right, we have a snapshot of some key statistics for the butterfly conservation, who are trying different initiatives to help arrest the decline in particular species of butterflies and moths. And on the bottom right, we have an extract from the Trustees Report of a religious order, which has been financially supporting a school out in Zambia, and a picture there of the new school playground that was built with the money that was given. There's a couple more points that I wanted to cover in this section, which are on the next slide. Trustees are also required to set out what they believe are the key risks to which the charity is exposed, and then also to note the mitigating actions that have been put in place to counter those risks. These risks should be familiar to all the trustees, as they're typically going to be taken from the charity's risk register, something that the trustees will have had sight of during the course of the year and discussed at their board meetings. And the second point, which is perhaps more important for charities that are actively fundraising, all charities that are required to undergo an audit are also required to note their approach to fundraising within their trustees report. And whilst this is a mandatory requirement, it can also be a good tool for giving confidence to potential supporters of your charity that the fundraising is being undertaken ethically and in a managed way. So just turning to the next slide, a couple more examples here. So on the left-hand side, we have a summary of the key, So on the left-hand side, we have a summary of the key risks of a charity, which has been provided neatly within a table format. And on the right-hand side, we have the statement from the charity Red Thread on its approach to fundraising. This is a charity which relies heavily on donations and has therefore dedicated a whole side of A4 to this statement to give clarity and confidence to the reader on its approach to fundraising. On the next slide, we move on to the financial review. This section of the report is going to be directly linked to the numbers contained within the financial statements that Sashi discussed a little bit earlier. As I say, a good financial review is one that's able to provide context over the numbers that are being presented, and also links well to the key achievements for the year that have been discussed elsewhere within the Trustees Report. This section should note the charity's key sources of income and the key areas of expenditure. But more than that, it should also help provide the reader with an understanding of any unexpected or unusual variances within the numbers. Were there any new projects undertaken? Was there a particularly large legacy that was received in the year? Were there any activities that needed to come to an end due to cessation of funding? On the right-hand side of the slide, we've included an extract of the financial review taken from the 2021 report of the Cardinal Hume Centre. You can see some really good use of charts and infographics here to help convey this key information. If your charity holds investments, it's also important here to confirm the charity's investment strategy is determined by the trustees and how the investments have actually fared during the course of the year. Another key responsibility for the trustees is considering the charity's reserve policy. That's the target level of reserves that the trustees believe the charity should be holding at any given point in time, which are not restricted or otherwise earmarked or tied up in fixed assets. That target needs to be commented on here together with the actual position at the year end and a conclusion drawn on whether the trustees are happy with the position or whether interventions may be needed to bring the reserves back to the level where it needs to be. The final section I wanted to cover on the next slide is in relation to structure, governance and management. This is the section that tends to change least year on year and is fairly static commentary, but at the same time hugely important in demonstrating the good governance arrangements of your charity. Here you need to confirm how the charity is constituted. Is it a trust? Is it a charitable company? Is it a CIO? You need to confirm who the trustees are, how they were appointed, how they were trained and inducted. And you also need to confirm how the organisation is structured. Who supports the trustees? Are there any subcommittees in place? Who else gets involved in the strategic decision making? Who are your key management personnel, and how is their remuneration determined? If there's other charities that you have a formal partnership with, or for example, if you've got a trading subsidiary, you would also want to explain those relationships within this section of the report. I think that's pretty much everything from me. The one very final thing I will mention is once you've finished drafting the report, definitely get someone who doesn't really know very much about your charity to read the draft report. There's definitely been times where I've reviewed a trustee's report and I can be 10, 15 pages deep into the report, but still not really quite clear in terms of what the charity's actually been doing. I think the issue is that often trustees and the management team who are often involved in drafting the report may be over familiar with the work of the charity and can therefore overlook some of the more fundamental commentary, which they may just see as a given. So getting that external perspective can definitely help improve the quality of your annual report. And that's everything from me. So I'll now hand over to Catherine, who will cover some more of the judgmental areas of reporting. Thank you.
Great, thank you, Jamal. So as you've been hearing this afternoon, there are lots of rules, lots of specific provisions that govern charity accounts, but quite often they don't necessarily tell us how we're expected to apply them. And this is because accounting and reporting in the UK is a principles-based activity rather than maybe being as prescriptive as it might be in the US or some other European countries, for example. So in the session that I'm going to cover, we're going to look at some of the areas where there are judgments and decisions that can be made and about how you might interpret those requirements, but also where there might be a variation in the financial value that you attribute to different areas in the financial statements and how that can then make a big difference to what gets reported in your accounts. So really, just for those of you that aren't sort of day-to-day accountants, really having a think about what areas in a set of charity accounts you might want to look into a bit deeper or maybe ask a few more questions on. So onto my first slide, we're going to be looking a bit at the sort of level of detail of financial information that you provide and maybe not giving too much detail for people to sort of get distracted with and sort of detract from the bigger picture of what you're trying to tell. Also looking at judgments and really trustees being able to sort of make accounting choices that are sort of based on the sort of key decisions affecting their charity. And reading between the lines, and what I mean here is, I suppose, making sure that you know what to look out for, what questions to ask if you're looking at someone else's accounts as well. So maybe if you're a trustee or a grant maker, you know what to look out for, and also that sometimes it might be just as important to sort of think about what isn't in those accounts that maybe should be. So really, what questions you should be asking. So on to the next slide, we're going to start by looking at some financial information as we've set out here. And I suppose really what stands out to you in these figures. And I think, to be fair, it is a bit of an exaggerated example. It does include some spelling errors even and some quite unhelpful descriptions. But I suppose really just showing that different stakeholders might be sort of looking at these figures and different things might be sort of jumping out at them in terms of comments that you might have. But then on my next slide, I have a slightly tidier version, exactly the same numbers, but hopefully you can see that the difference in presentation here, you know, actually clarifies matters to an extent. I mean, I think I possibly would sort of tidy it up even further. Maybe there are quite a lot of very small figures there in terms of some of the other expenses, so I might be tempted to sort of put all of that under one heading and then maybe provide some more detail in the notes to the accounts instead, if someone was particularly interested in that detail. But I think the point is that you've got some big headings there, so some of those sort of service provision headings, but actually there could be maybe 3 or 4 different types of expenditure within that, and you know, within each of those there might be sort of variances year on year, so actually probably providing a bit more explanation, a bit more detail on each of those headings would be useful as well. Similarly, the salaries, it doesn't really tell you what salaries relate to what activities, you know, as Saatchi was talking about earlier when you were talking about charitable activities, so that kind of thing. And then some of those smaller figures really considering do you need to include all of that information? Sometimes a set of some additional information is included in accounts because somebody asks about it one year, or somebody wants to provide a bit more detail, but actually then it gets added year on year, and potentially it's a bit too specific and detracting from the bigger picture. So on to the next slide, please. I think really the probably one of the key judgments when we're preparing a set of financial statements is assessing sort of financial solvency, so whether you're remaining a going concern. And this has always been a key judgment, but in the sort of current circumstances, so coming through and dealing with the impact and the aftermath of the COVID pandemic, the situation in Ukraine now, the cost of living crisis, a lot of organisations are actually now under quite a bit of financial pressure, and actually assessing whether or not they're going to make it through the next 12 months has become a bit more of a question mark, perhaps. So going concern is a concept that accountants use, and sometimes it can cause a bit of sort of apprehension and maybe a bit more worry that it needs to. And basically what it means, it's the principle that you prepare your accounts on the assumption that you're going to be an ongoing business, you're still going to be here in a year's time, you're able to sort of pay your debts as you go along. And it's not based on certainty, nobody has that certainty, but it is supposed to be based on that sort of probability that if you continue to get the income in as you'd expect and as you normally do, then you can manage your expenses and you'd be able to carry on as an ongoing charity. There's always going to be an element of uncertainty, some assumptions that you make, and sometimes when maybe trustees are coming from a commercial sector and are looking at a set of charity accounts, there can be sort of a bit of nervousness there, particularly maybe around fundraising targets, that kind of thing, where maybe it's not clear that the income is going to come in until quite a bit later on in the year. So, you know, unlike a lot of trading organisations, in some cases for a charity and income depends on the type of charity, but income can be a bit less predictable. In terms of going concern disclosures, it used to be the case that if you saw the words going concern sort of mentioned anywhere in a set of accounts, you did get a bit worried, and it wasn't really something that was ever referred to unless, you know, you had to, because there was real concern, or you were maybe about to wind up and you had to make that relevant disclosure. But these days it is the default position. So every set of accounts you prepare, you need to disclose that the basis on which you're preparing those is the going concern basis, and usually that there are no material uncertainties around that. If there were to be any material uncertainties, then you just have to sort of explain that, set out what they are, and really give your stakeholders the reassurance of how you plan to manage them and address them. There's also now the case that auditors will need to report on going concern in every set of accounts. So you will have seen that audit reports have sort of got a bit longer there. But typically what we'd be saying is that we can agree or concur with the conclusion that the accounts should be prepared on the going concern basis, and that we don't think that there are any material uncertainties that we need to flag. So I think that's what's important, really, just making sure that you're portraying and explaining those assessments and assumptions that you've used quite clearly in your accounts. So on the next slide, I actually have an example to sort of look at solvency. And really just looking at this information, answering that sort of simple question, do we think this charity is solvent? And I think if we have a quick look at these figures, you know, if you were a commercial organisation, you saw that sort of positive net current asset balance, obviously within the context of the sort of scale of trade and income and expenditure, but you would probably be quite happy that it's a solvent organisation. You'd probably sort of ignore the 1 million of fixed assets because you can't really dispose of those assets and turn them into working capital. You need them to run the organisation, but you've got that 150,000 of net current assets. But it is a bit more subtle when it comes to a charity. So on the next slide, you will see that we have this additional breakdown of the same figures between funds, and this breakdown is something that should be included in every set of charity accounts. It's called the net assets between funds note, and it is usually towards the end of the accounts, but you can also present your balance sheet in this fund format in a similar way to the SOFA as Saatchi covered earlier in the session. But here you can see that you sort of split in the assets and liabilities of the organisation across the different funds that those assets and liabilities belong to. And that actually presents quite a different picture. So again, normally ignoring the fixed assets here. In a charity, you would typically designate the fixed asset fund because you can't sort of use those assets. You need them to run your charity. You may also have decided that you want to sort of invest in a new project or something like that. So you may have additionally set aside some of your liquid assets into a designated fund. So then also on the right-hand side, you've got the restricted funds, so just before the total column. And these are the funds, as Saatchi was saying, that you're sort of being given for particular purposes. So they're sort of sitting there waiting to be spent for those particular purposes. You can't sort of use them on any purpose of the charity that you wish. So then actually that leaves you the sort of the middle column of the general funds, and that's what you would normally regard as being the sort of the reserves of the charity. And Jamal just talked about what reserves are and reserves policy in his session. And here, unfortunately, you can see that negative 300,000, which we've sort of put in red to make it even more obvious. So what that means is that when you think about this charity's reserves, even though when we first looked at the balance sheet on the previous slide, it looked like quite a healthy position, actually they've got a serious deficit problem on their general fund. So, you know, this is something that you would have to ask some more questions on and really get to understand a bit more. I want to talk about accounting policies now on my next slide. And there are some accounting policy areas where actually there's quite a lot of judgment and decision making involved, and really it is important to sort of understand the specifics and kind of what's behind that, so that you can understand what figures that results in the accounts. So the ones that I'm going to sort of pick on briefly are going to be depreciation, fixed assets. We're going to look at cutoff and timing, so really looking at sort of what period items belong in, and then the principles around entitlement and measurement, which Saatchi touched on earlier. So looking at those in a little bit more detail, where there particularly can be measurement uncertainty, and then finally some of the specific disclosures that you need to include in accounts. So next slide, please. So we have some images here to help us focus on what depreciation is and the sort of key things that we need to think about. And the first picture is a building. And I suppose building can be a bit controversial when it comes to depreciation, because most people sort of think, well, buildings tend to, property tends to appreciate in value, so why should we be reflecting a sort of reduction in our accounts every year? But the accounting principle is that you need to recognise the cost of acquiring that building over the length of time that you're going to be able to use it for, and that is usually restricted to 50 years at most. However, there are cases where, particularly because of the sort of the nature of the building maybe, that you might establish that the value is never going to be used up, and in which case it might be appropriate to not depreciate it. But I think the point to make here is that you know, really the decisions around the useful economic life of that building, the depreciation associated as a result of an asset which is of such significant value, is going to make a big difference to the expenditure that you recognise in your accounts every year. The middle picture is a Babbage analytical engine, which is a very old computer, but this is really just to illustrate the point about useful economic life of IT equipment, and really that sometimes this has been set as maybe longer in accounting policies than would actually be the case. So you know, nowadays you may be actually replacing IT equipment a lot more quickly than maybe what you would typically see in a set of accounting policies. On the other hand, you'd also need to be mindful that you don't want to have lots of assets that have sort of been fully depreciated, but actually you're still using. So again, just making sure that you're thinking about the useful economic life when you're acquiring assets, and how that's going to be, you know, of particular relevance to your charity. How are you going to use those assets in your particular circumstances? And then the final one is to sort of illustrate the point of what's called component accounting. So the picture is actually the MS Oldenburg, but really it's a boat. And I think the issue is here is, do we look at this as just the one asset, the boat, or is it actually a collection of sort of quite different assets which all have different useful economic lives? So maybe the hull and the main structure, I don't know, a life of 30, 40, 50 years, but then you might have radios, you might have catering equipment, different different periods of time, those things are going to last. So really just to illustrate the point that, accounting standards say that where you've got quite a number of different things, a collection of assets, and each individually is sort of significant in its own right, then you should be writing those off over their useful economic life. So on to the next slide. Yes, I have another picture round. It is a bit old, but it still sort of explains the point that I want to make. So Jamie Hewitt, he took part in a TV challenge program for one of our clients, and he declared at the end of the program that he was going to pledge all of the money that he'd won for this particular charity, which happened to be one of our clients. So the point here is that because that pledge had been made before the charity's financial year end, even though then the funds didn't actually come through from the TV programme until some time after the year end, because they deemed actually this was quite a credible pledge, it was made very publicly on television, the charity actually recognised this as income and recognised a debtor on their balance sheet at the year end. So the charity could have also decided, I guess, not to do that if they had concerns over the likelihood of receipts. So really understanding the decisions and judgment behind those figures in the accounts is important. The mobile phones picture, so this refers to the fact that these are goods for distribution, and a lot of organisations might collect second-hand IT equipment and then distribute it in countries where there's a need. But the phones would only be recognised to the extent that they're actually of value to sort of anyone or to the organisation. And here you would have maybe some charities that have shops, and they maybe would try and recognise the donated assets into the shop as they receive them, put a value on them, and record that in the accounts. Whereas you may have other organisations, other charities that might say, well, that's too difficult to arrive at a value. It's not really the right thing to do. We'll recognise these donated assets only once we sell them on or once we give them on to third parties. So again, that's going to be showing quite different position in their accounts. So understanding that policy and what drives those figures is going to be important. And then the final point is around paperwork, and really there are lots of clauses in the charity SORP that say that you can't use paperwork as an excuse to sort of not follow the accounting rules properly. So just because you've got a grant agreement that says you need to submit a report at the end of the project, it doesn't mean that you're not entitled to the income as you deliver the project. But again, some charities might sort of say, well, we've got a policy that says we don't recognise the income until we submit the report, and that actually would make quite a big difference. As you can see, in the first instance, you would have a charity recognising income as they go, so really no real impact on funds as the project progresses, whereas in the second instance, you'd have a big deficit building up, I suppose, right until the end of the project, when all of a sudden you're recognising the income. So again, understanding the basis and what drives those figures in the financial statements is really important. On my next slide, I wanted to talk about two particular areas in charity accounts where actually interpreting the SORP's recognition criteria for income, expenditure, assets and liabilities can be a bit more judgmental or nuanced. And this is legacies and provisions for grants liabilities. So as you heard earlier, the SORP criteria that you need to meet in order to recognise income is entitlement, and then the probability that you receive the money and being able to measure reliably. So in legacies, normally if you know the values within the will, you normally take probate at the point at which you recognise, and that's when it comes into your accounts. Some charities would maybe do it a bit earlier or later. So, if they think that there might be some disputes within the estate or the assets are held in jurisdictions where they'd be difficult to realise. So again, understanding the assumptions and estimates behind that would be important. On the next slide, just looking at the multi-year funding of grants, and you may, most of us might think that if you've got a sort of multi-year funding, you might be funding a student, for example, over a number of years, then you would recognise the spend over the time that they're maybe sort of doing the course and so on. But unfortunately, that's not what the SORP says. If you have an open-ended commitment and there's no further barrier to you having to pay out that money, then you would have to recognise that all up front as soon as you make the commitment. but you can, in a funding agreement, there might be some kind of sort of minimal review each year, maybe check the students attending the course or meeting the grades, as it were. And I think as long as those review points, you can actually break the funding in principle, then you could recognise that over the 3 years if, as the student passes those points. On the next slide, just really another judgmental area is designated funds. We touched on this a bit earlier, but these are where the funds have been set aside for a particular sort of project in the future, an asset, a new activity. But that's only a decision that happens within the organisation. So the trustees set aside those funds, but maybe the next day they could sort of wake up and decide to sort of undesignate them. So again, it is very judgmental, but while those funds are set aside, as long as it's a credible purpose and there is that clear intention, then they don't form part of your reserves. And then on my final slide, again, just to come back to the point that I made right at the beginning, which was that it is important to also think about what might not be said in a set of financial statements. So what might be missing, and it's important to us as auditors, but it should also be important for you as trustees or grant makers if you want to ask those sort of key pertinent questions. So restricted funds, we've talked about that a bit already. You need to have the detail of what those funds are, who provided them, what the purpose is. If you've not got that breakdown, maybe ask a few more questions. The reserves policy, making sure that's understandable, that it doesn't change every year just to match with what funds you've got. Again, always worth looking into that. The note that we saw earlier when we were looking at the assets and liabilities between funds, making sure that that's there. If it's not, then maybe ask some questions. Does it show a slightly less favourable picture than the balance sheet in its totality, for example? And then finally, any sort of relationships in terms of related party transactions with other organisations or maybe a founder, making sure that those kind of disclosures are properly included within a set of accounts. So that's all I wanted to cover, and I will now hand back to Saatchi.
Thanks, Catherine. So as you can see from the last hour, there's a lot of information we've tried to cram in an hour. We do have a longer seminar for all 3 topics, so please do watch out for that on our website, and if you're interested in going into some of the detail. In terms of questions, there are 2 questions, and one of them is entirely my fault. I should have said right at the start, you will get slides. So lots of questions saying, will you be sharing the slides? And the answer is absolutely. Our marketing team will be circulating to all attendees the slides. And one other question was a point of clarification, which was I had mentioned that for charities with income of more than £1 million, you need an audit. On my slide, I had put the information but omitted to actually explain it. If your charity has assets, you're very asset rich, that is, you've got assets of more than 3.26 million, but your income is low, so it's below £1 million, but more than £250,000, then you also need an audit. So it's not just the £1 million in isolation, you need to look at your asset base. But again, we've clarified that on the slide. So I think those are all the questions that have been posted. We will go through everything on the chat, and in case we've missed any questions, we will email our responses to you as well. So thank you very much for listening to us, and hope to see you soon. Thanks.